Nvidia is more than a semiconductor company. It's a symbol of technological transformation, a company whose influence stretches far beyond the chips it designs. In the world of modern computing, Nvidia stands at the crossroads of innovation and industry, shaping the future of artificial intelligence, gaming, and data processing. It's the AI revolution's powerhouse, fueling breakthroughs in machine learning, autonomous vehicles, robotics, and scientific research. Every major leap in AI capabilities seems to have Nvidia's fingerprints on it, from the labs of top universities to the data centers of global tech giants. Its GPUs drive everything from AI models to sprawling data centers, making its quarterly earnings reports not just a financial update, but a pulse check for the entire tech ecosystem. When Nvidia speaks, the world listens, because its performance signals where technology is headed next. These reports are a barometer for the tech sector and the broader economy, offering clues about demand for cutting-edge computing power and the health of industries that depend on it. Investors see them as pivotal, capable of shifting billions in market value in a single afternoon. The stakes are high, and the ripple effects can be felt across global markets. Analysts refine forecasts, traders bet big, and news networks buzz with anticipation. The lead-up to Nvidia's earnings is a spectacle, with experts dissecting every hint and rumor for clues. Nvidia's results reveal the world's appetite for AI infrastructure. Surging demand for its chips can mean a boom in cloud computing, scientific research, and next-generation applications. Heavy spending on Nvidia chips signals tech confidence and aggressive investment in the future. A slowdown, on the other hand, hints at economic caution or shifting priorities in the industry. Earnings reports are high stakes, affecting more than just shareholders. Employees, partners, and even competitors watch closely, knowing that Nvidia's fortunes can influence hiring, investment, and innovation across the sector. Understanding these dynamics is critical for investors, whether they're seasoned professionals or newcomers trying to make sense of the market's next move. It's not just about beating Wall Street's expectations. The story behind the numbers, growth in new markets, supply chain resilience, and strategic partnerships can be just as important. Details like data center growth and gaming sales matter, revealing how Nvidia's technology is being adopted and where future opportunities may lie. Future revenue projections drive stock reactions, as investors look for signs of sustained momentum or potential headwinds. Strong earnings can be overshadowed by weak guidance, reminding everyone that in the fast-moving world of tech, tomorrow's outlook often matters more than today's results. Preparing for Nvidia's report involves understanding fundamentals, market sentiment, and the broader context of technological change. It's about reading between the lines and anticipating how the world will react. It's a convergence of business performance and investor psychology, where numbers meet narratives and expectations shape reality. For the informed, it's an opportunity to act decisively. For the unprepared, it's a source of volatility and uncertainty. In the end, Nvidia's earnings are more than just numbers. They're a window into the future of technology and the markets that depend on it. History may not repeat, but it often rhymes, especially when it comes to Nvidia's earnings reports. Over the years, Nvidia has become a bellwether for the tech sector, and its earnings announcements are closely watched by investors, analysts, and traders alike. Each quarter, anticipation builds as the company prepares to release its results, and the market braces for what's next. The stock tends to make large, sometimes dramatic moves after earnings are announced, often swinging by double-digit percentages in either direction. This pattern of volatility is a hallmark of Nvidia's post-earnings trading sessions. This volatility stems from a combination of high expectations, Nvidia's premium valuation, and the company's pivotal role in fast-growing industries like AI and gaming. Investors are quick to react to any surprises, good or bad. Nvidia frequently beats Wall Street estimates, which has conditioned investors to expect strong numbers every quarter. This track record of outperformance has set a high bar for future results. Yet, even when Nvidia posts record-breaking revenue or profit, the stock can still fall if those results don't exceed the so-called whisper numbers, the unofficial, often higher expectations circulating among traders. The bar is high. Sometimes, even great news isn't enough to satisfy the market's appetite for growth. Investors can be quick to punish the stock if guidance or future outlook falls short. The buy the rumor, sell the news phenomenon is especially common with Nvidia. Traders often bid up the stock in anticipation of strong results, only to sell once the news is out, locking in profits or reacting to any perceived weakness. It's not unusual to see Nvidia's stock rally in the days leading up to earnings, followed by a sharp pullback immediately after, even if the company delivers solid numbers. Understanding this dynamic is crucial for anyone trading around earnings. It's a reminder that market psychology and expectations can matter as much as the actual results. Historical data underscores one key lesson. With Nvidia, expect the unexpected. The stock's reaction can defy logic, making it both exciting and risky. Nvidia's post-earnings moves are shaped by a complex interplay of headline numbers, forward guidance, and overall market sentiment. Each element can tip the scales. The average post-earnings move is substantial, making Nvidia a high-risk, high-reward stock for active traders and investors who thrive on volatility. To navigate this uncertainty, many traders turn to option strategies, using calls and puts to manage risk and structure their bets around earnings events. Implied volatility, often called IV, is a crucial concept for traders, especially during major events like Nvidia's earnings announcements. It represents the market's expectations for how much a stock's price might move in the near future and is a key factor in options trading strategies. Think of IV as a weather forecast for the stock market. It doesn't predict the direction of the move, but it does signal how turbulent or calm the market expects things to be. When implied volatility is high, it means traders are bracing for big price swings, much like preparing for a storm. On the other hand, low IV suggests the market expects a period of relative calm, with smaller price changes. IV is calculated from the prices of options contracts. Before earnings reports, IV often spikes because traders anticipate surprises that could send the stock sharply up or down. After the earnings are released and the uncertainty fades, IV typically drops sharply, a phenomenon known as the IV crush. Implied volatility gives traders a data-driven estimate of how much a stock could move, helping them plan their trades and manage risk more effectively. For example, if options are pricing in a 10% move for Nvidia after earnings, that means the market expects a significant swing, even if it's unclear whether it will be up or down. By comparing your own predictions to the implied volatility, you can see if your expectations are in line with the broader market consensus, or if you're taking a contrarian stance. High IV means options are more expensive, since the potential for big moves increases the risk for sellers. To manage these higher costs, many traders use strategies like spreads. Spreads allow traders to profit from directional moves while also reducing the negative impact of IV dropping after earnings, known as IV crush. Mastering implied volatility is essential for effective risk management, as it helps you avoid overpaying for options and better anticipate market reactions. In essence, implied volatility acts like a speedometer for market expectations, giving you a real-time gauge of how fast or slow the market thinks things might move. High implied volatility makes options costly, so traders use spreads. A spread involves buying one option and selling another, reducing cost and defining risk. It's a nuanced prediction tool. A bull call spread bets on a modest upward move. Buy a lower strike call, sell a higher strike call, both with the same expiration. This caps profit but limits loss to the initial cost. Bear put spreads work similarly for downward bets. Spreads mitigate IV crush impact, balancing risk and reward. They're popular for earnings due to defined risk and cost efficiency. Spreads are precision tools in a trader's arsenal. In August 2025, Nvidia's earnings report was highly anticipated. The stock surged 25% pre-announcement, with IV suggesting a 12% move. Nvidia beat expectations, with data center growth at 180%. Initial after-hours trading spiked 6%, but guidance tempered enthusiasm. Supply chain concerns and moderate forecasts led to a sell-the-news reaction. The stock opened down 4% the next day. Traders with bull call spreads managed risk better than outright call buyers. Bear put spread users or premium sellers like iron condors profited. The event highlighted the importance of strategy over mere speculation. Meeting high expectations isn't always enough. The devil is in the details. As November 2025's earnings approach, Nvidia's stock is buzzing. Options suggest a 9.5% expected move, indicating market anticipation. The put-to-call ratio shows caution, with elevated put buying for downside protection. Significant open interest in calls and puts reveals diverse trader expectations. Spreads are popular, with iron condors betting on less volatility than priced. Directional spreads target specific price levels. The market hopes for upside, but braces for potential moderation. Traders are positioning for both outcomes. The options chain offers a real-time sentiment snapshot. It's a hive of activity as the report nears. Preparation is key before Nvidia's earnings release. Establish expectations by knowing Wall Street forecasts. Contextualize results against consensus estimates. Monitor stock price action and implied volatility pre-report. Review past performance and management commentary for context. Have a plan for various scenarios post-release. Decide on actions for different stock movements. A clear strategy prevents impulsive decisions. Preparation is your best defense. Post-earnings, the real work begins. Initial after-hours moves can be misleading. The earnings call is crucial for context and future outlook. Listen for management's tone and answers to analyst questions. Analyze new information against your investment thesis. Traders must manage positions, considering IV crush effects. Watch for analyst revisions and market consensus shifts. Post-earnings drift can confirm your analysis. The initial reaction is just the start. The narrative unfolds over days. Decisive action is often required. The aftermath is about strategy and analysis. It's a critical phase for informed decision-making. Trading Nvidia's earnings is high stakes but manageable with strategy. Respect history. Nvidia's price swings are significant. Implied volatility quantifies market expectations. Use risk-defined strategies like spreads to navigate volatility. Preparation involves knowing estimates, tracking pre-earnings moves, and planning. Post-announcement, focus on the conference call and market digestion. Combine historical patterns with real-time data for informed decisions. Ground your strategy in fundamentals and sentiment. Approach with preparation and respect for volatility. Be an informed participant, not a passive spectator.